Okay, ladies and gentlemen, come to the third session of our seminar programme. A few months ago when I was putting this programme together, I thought I'd give it a shot and ask Lynda Blackwell to say if she'd be prepared to come to Manchester in the full expectation that she'd probably say no. But she agreed to come, and she came for, I think, 3 reasons. One of those is that the FSA is still in listening mode on the MMR. And as the manager at the FSA responsible for MMR, and she has a whole team working for her, ultimately what comes out of this, I'm going to put fairly and squarely on Lynda's head, although there's a whole lot of other people above her who have to sign all this off at the FSA. Therefore, it's very important, I think, to hear what she's got to say and understand why the FSA think and believe what they believe. Because we understand our world, lenders understand their world, and the FSA is trying to make sense of that from their perspective, and it isn't always with a full understanding of all of those perspectives. And Lynda and I regularly talk about why she hears certain things from certain parties at various times. So I'm very grateful for her taking the time to come and talk to us today, and she's going to talk, and we're going to do a bit of a Q&A session as well, because Lynda is interested to hear your views. And in hearing those views, I would ask you to remember one thing. She is our guest, and we should treat our guests as we would want to be treated as guests ourselves. She is here to listen and to try to understand, but that means, therefore, I hope you will use this to educate in a way that's responsible, because I think that's what anybody who comes here as our guest deserves. And trust me, over the last 3 years of working MMR with Lynda, I've had some very heated debates with her, but she does listen, and her team do listen, and therefore I please ask you to make sure that she walks away from here with the right impression of us wanting to do the right thing for consumers, not the right thing for ourselves, and that's very important. Okay. And without further ado, I'll hand you over to Lynda, who will talk you through some slides which have got a lot of interesting things in them, and then we'll do a bit of Q&A at the end. Lynda.
I don't think this is going to sit here, Robert. Okay, well, hello everyone. Having made the mistake of sitting through the last couple of sessions, I feel a bit like the Christian coming into the lion's den. Thank you very much, Robert, for the invitation to come and talk to you all today about the mortgage market review, which is now moving into its final stages. And it's been a long time getting here. It started in 2009. And we've had lots of discussion papers and consultation papers along the way. The time that we've taken on this reflects the importance of getting regulation of the mortgage market right and basing what we do on detailed analysis of the facts. So we've had very extensive debate and discussion with everyone involved, and that's the trade bodies, brokers, the lenders from the biggest banks right down to the very smallest building societies, consumer representatives, and we've actually had lots of individual consumers write into us to tell us what they think about this. It matters to everyone to get this right, none so more than us, and I do hope that we've shown that we are ready to listen. Being able to talk through our ideas and hear what the industry thinks has been invaluable. And Amy has certainly engaged very closely with us. As Robert says, we've had lots of heated discussions over the past few years. We place particular value in having constructive, open discussions that are rooted in the real world, not pretending that things are other than they are. And that's certainly something that we've consistently got from Amy. And I have to say that on a personal note, I'm really pleased that the recent changes mean that we will benefit from Amy's greater focus on our work, which, of course, in turn benefits all of you. So, in the promotional material for today, Robert said that this event will allow brokers in the north, who are having a tougher time than brokers in the south, to come along and debate the topics of the day. And I know that there are a bucket load of issues that you're all grappling with, not least regulatory costs. The FSCS, I actually hesitate to mention some of these things. the claims management companies, the RDR burdens, you know, the list goes on. And I also know that many of you are facing what seems to be daily changes to lending criteria. We've seen the stream of lenders, we sort of touched on this earlier, the stream of lenders changing their interest-only policies ahead of any MMR changes. My team and I also read the trade blogs, which makes for interesting reading. And we can sense the frustration with the current computer says yes or computer says no approach to lending, and the fact that it's increasingly difficult for you to place cases with any degree of certainty that they're going to be accepted. That's why I'm going to take a little time today to sort of set the record straight about the MMR. And also, as Robert says, I want to actually spend some time listening to you. I don't want to spend all of the time talking at you. I'm going to try and keep what I have to say relatively short to give you the time to have your say and to help continue shaping our thinking. Currently, we're in the process of analysing the 120 plus responses that we've had to the latest consultation paper. There's still some way to go yet, and we're continuing our discussions with firms and trade bodies. The fact is that the fat lady has not sung yet, and that's a really important point. Even though we've yet to publish our final policy position and the final rules, as I mentioned earlier, we often read that it's the MMR that's causing lenders to curtail their lending, and it's the MMR that's leading to this excessively cautious and risk-averse approach on the part of lenders. And of course, that in turn makes life increasingly difficult for you. But it's all too easy to hide behind the MMR. The reality is that with funding so much thinner on the ground, it makes commercial sense for this flight to quality. Lenders are, of course, going to use the available money to support higher quality lending. That makes commercial sense. We've certainly seen a very significant reduction in risk appetite since the height of the market in 2007. And this scatter plot actually is quite interesting because it shows the change in lending risks and arrears among lenders that lent in both 2007 and 2010. So the purple and the yellow dots show the level of risk-taking in 2007. And in fact, the yellow dots represent those lenders who paid the ultimate price for their high-risk lending. And in 2010, they were no longer lending. They'd exited the market completely, or they'd been forced to merge with other lenders. The red dots show the level of risk in 2010 and the considerable improvement in performance. So the risk profile of lending has changed really very dramatically. And can that simply be put down to the MMR? Or could it be the other pressures? Because this morning we've been thinking about those other pressures, and there are really very significant pressures on firms today. And we've heard all about the supply and the demand side, and I actually want to look at that, because on the supply side, firms are lending less. And that they're doing that in the face of, as John Wrigglesworth noted, the higher capital requirements. And here you see the Tier 1 capital ratios. And the right-hand, second from the right, this column illustrates just how much more capital UK banks need to hold in 2011 as compared to 2007. And it's really very significant. And one of the things, I mean, this is the Godzilla that John Wrigglesworth was mentioning. It's very interesting to note that it's not just the UK, of course. This is international banking systems being affected by Basel III. And as a result of this, we're seeing banks deleveraging to meet these requirements. And you'll see from the red dotted line that for some UK banks, the extent of the deleveraging is really very marked. And of course, funding costs are really high. I mean, this is all the news of the moment. We had the governor last week warning us that homeowners are likely to face further rises in mortgage rates as a result of the deepening turmoil in the Eurozone. Lenders' margins have been negative for some time, and so we've seen many firms recently moving to increase their SVRs in order to improve those margins. And if you look at the proportion of regulated mortgage balances on variable rates, there's been a huge increase of the number of consumers who have standard variable rate mortgages. So there are lots of people who are going to feel the squeeze as those rates start to move upwards. So on the supply side, and we've already touched on this morning, there is a very real problem, but also there are real issues on the demand side. And we've seen the decrease in house prices. I think if you strip out London, which is the top blue line, house prices are on their way down, and certainly, as John Wrigglesworth described it, they're not headed up. That's putting a real damper on the housing market. But house price falls and the incidence of negative equity have been larger in northern regions, and it's very interesting to look at it on a regional basis, because if you look at the red line, that shows that house prices have fallen much more in the northwest. And if you look at negative equity by region, there we have the good old northwest, which is really significantly higher than other areas. And that reflects the fact that we saw high loan-to-value lending concentrated in the northern regions. And if we drill down even further into Manchester, here we see it, Manchester Central is running at almost 18%. And of course, in Manchester Central, that's where we saw all the new build flats. And of course, unemployment is rising. You can see that it's really the younger people, the younger age groups who are really struggling. And of course, they have very little prospect of getting onto the housing ladder and accessing mortgage finance, given that their incomes bear very little resemblance to house price increases, and not helped by the much larger deposits that they have to find today. And of course, again, the picture in the north is worse. Here you have the unemployment rate for Manchester. It's running at 11.4%, and that contrasts with just under 8% for the national average. So, not surprising, average household expenditure, that is the family spending power, has reduced. And actually, it's really pretty dramatic. And again, if you look at Manchester, the average earnings per week in Manchester is £433 compared to average national earnings, £503. I think it's all summed up pretty neatly, actually, in the Present Situation Index. This is the nationwide Present Situation Index. Basically, consumer confidence has bombed, and given all the news that we're hearing today, I don't think that's going to go anywhere soon. Well, we heard John Wrigglesworth saying earlier, well, arrears are just half of what they were in the 1990s. But actually, you know, it's still not a very healthy picture. If you look at the arrears, the long-term arrears and repossessions, actually, it's pretty bad. And there have been particular problems for specific types of consumers and in specific areas around the country, with too many consumers facing the distress of arrears and possessions. So if you look at the regional performance, if you particularly look over at the repossessions in the right-hand table, again, concentrated in the north. And I think the long-term trend puts it all really into context. You know, although there may be a reasonably favourable picture overall, in the north, the number of possession orders being made against borrowers is as bad as it was in the 1990s. And, you know, these are real people losing their homes. The scale of payment problems, of course, would have been significantly greater if interest rates hadn't fallen to, and then actually been kept at the exceptionally low levels they're at today. And the potential scale of the problems, of course, is likely to get much worse as rates start to move upwards. So that's a summary of where the market is today. Robert mentioned brokers in the north having a much tougher time than their southern counterparts, and that is certainly something that we recognise. The vulnerabilities we saw in the market as a result of lending being increasingly pushed along the risk curve are seen in the northern regions more than others. It's tough, and lenders have responded to the economic reality they and their customers face, and obviously that's going to impact on you. You know, I don't need to tell you that the reduction in lending has led to a steady decline in the number of broker firms. You can see just exactly what that picture looks like. If we go back to the reduction in lenders' risk appetites after the crisis, those yellow dots, those are the firms that have exited the market, and those were in the main non-deposit taking lenders, the non-banks who don't have a branch share, and they relied on the existing well-established intermediary channel in the UK to sell their mortgages. You know, the loss of so many of those firms, that huge capacity that's been lost to the market, has had an obvious knock-on effect on the broker community. And the market correction in response to market conditions, which has gone beyond potential MMR constraints, obviously has also had an impact on lending volumes. You know, I mentioned earlier the lack of certainty on the part of brokers about whether cases that they're placing are going to be accepted. And here you can see the widening gulf between applications and approvals. So it's not a pretty picture, and we need to learn lessons from this. I think that what the MMR wants to do is ensure that we have a sustainable market where the great majority of borrowers who can afford it can access mortgage credit, but at the same time we want to prevent the poor practices we saw in the past, which has led to consumer detriment, and which, as we've seen, has been particularly felt in these areas, the northern regions. So I'm really pleased to say that in the responses to the latest consultation paper, there seems to be a general consensus that what we are trying to do in the MMR will actually achieve the aims that we wanted to achieve. And it's good to hear that. And that actually includes the interest-only stuff, by the way, which I don't cover, but I will come back to at the end. Robert, you have to remind me to do that. At the heart of our proposals are the three common sense principles of good mortgage underwriting, and it's not rocket science, and I'm not going to spend too much time on this. They're missing. I don't need to spend too much time on this. Basically, we've got three principles, and one is lenders can't just rely on the fact that house price increases are always going to be in an upward trend. They actually do have to think about whether the borrower can afford to pay the mortgage, and therefore they do need to assess affordability. The second is that borrowers also shouldn't be allowed to enter into contracts which are only affordable on the basis that interest rates won't go up and that the initial low interest rates will last forever. There has to be a sensible stress test against the fact that interest rates are likely to go up. And finally, consumers do have to be able to pay the capital element as well as the monthly interest payments. Firms can't just ignore the fact that there's a capital sum that needs to be repaid at the end of the term. Three basic common sense principles of good underwriting. Basically, I think we've arrived at a balanced blend of prescriptive rules and general principles that leave some flexibility for both lenders and consumers, and this has generally been welcomed. For brokers, of course, a one-size-fits-all approach is not where you add value. And I have to say, actually, we think that where we've ended up in the interest-only proposals allows you those opportunities, because basically we are saying firms, we are not being prescriptive. We've listened. We're not being prescriptive about the type of repayment vehicle. we're not banning interest only. I heard comments earlier about the fact that the FSA is banning them. We're not. We recognise that they can be the right product for the right person. We at one point asked the market if we should be prescriptive about the type of repayment vehicles that should be allowed. The market came back to us and said, no, we need to be able to deal with it on a case-by-case basis. And I would have thought that that's an opportunity for brokers to find the product that meets your particular customer's needs and circumstances. It's quite interesting to hear the discussion that's been going on about interest only. I'm very happy to come back to it at the end. The concerns, what we're now hearing in the feedback, the concerns we're now hearing about the responsible lending side are not focused on the principles. They are generally on how the FSA, and in particular its successor body, the FCA, is going to apply the new rules in practice. And we've also had some interesting comments about the transitional arrangements. Amy, amongst others, has expressed a concern that there's a risk that the way that our rules are interpreted in practice may differ from the original policy intention, making firms overly risk-averse and reducing choice for consumers. Well, having spent a considerable amount of time on this project, I've got a vested interest in this, and obviously we too want to make sure that this doesn't happen. So we're working with our colleagues who will see this review through with the firms they regulate to make sure that what we intended to happen in practice actually does. I think the transitional arrangements have been the sticky part of the latest consultation. What we've said is that we recognise that our strengthened affordability proposals are likely to mean that some borrowers, those who took out self-certified mortgages, for example, or those who took out an interest-only mortgage with no plans for repaying the capital, may have difficulty in remortgaging. And, we recognise that. So what we've said is that to mitigate the impact of our proposals, we want to put in place special arrangements to help transition borrowers from the current regime to the new mortgage rules. And basically, what we've suggested, we can't force lenders to lend, by the way. That's a commercial decision for a lender. So what we've said is that we will put a provision in place, which is an enabling provision, which enables lenders to basically switch off the new affordability requirements with the aim of allowing existing borrowers with a good payment history to be able to enter into a new mortgage for the same amount or less. We feel that we do need to put conditions in place to ensure that the arrangements are used appropriately. So basically, we didn't pretend that we've got this right, by the way. We put into the market, in the consultation paper, our suggested approach to this, and we asked the market to tell us whether, whether we could improve it, or whether it was too complicated, or what does the market feel about this? And actually, we've had lots of really very helpful suggestions. I think there is a concern that we may have been too restrictive in not allowing borrowers to borrow more, and also in not allowing borrowers to increase their payments. So we need to think about this when we finalise our rules. We recognise that there are times when that is the sensible thing to do. For example, if a consumer wants to change to fixed rate mortgage to ensure a greater degree of certainty about their expenditure, and yet that means an increase in their monthly payments, then it may actually be in their best interests to do that. We are continuing to analyse the responses, and we will continue to discuss this with the trade bodies and with firms before we finalise our policy. I think despite all the problems that we noted earlier, overall, it's actually really encouraging to see that the intermediaries' market share has shown considerable resilience. So there you are, you can see you're still hanging on in there up at 50%. And I personally, and I think this is our view, is that given customer preferences for buying a mortgage with advice, we would expect brokers to continue to play a strong role in the market. I have to say it was really encouraging to hear the intermediary lenders earlier talking about the opportunities that there are for brokers. A mortgage is one of the biggest financial commitments a consumer will ever make, and most consumers opt for help when buying a mortgage. And even in online systems, what we're seeing today is a move towards providing consumers with a live chat option, where the customer can get their questions answered online in real time. Because basically, when you're making that sort of financial commitment, you want to be sure that you're making the right decision. And consumers want to talk to somebody about it and get that reassurance. That brings us on to what has actually proved to be, although you wouldn't think it having heard the intermediary lenders, but what has proved to be the most contentious part of the latest set of proposals, and that's the proposed removal of the non-advised sales process. Now, what we're proposing under the MMR will mean that the majority of sales will be advised. Currently, about 70% of sales are advised, and the vast majority, of course, are through intermediaries. While the number of advised direct sales have been steadily increasing, you can see that from 2006, when it was about 35%, it's now around 50% today. That means there's still a considerable proportion of consumers who do not get advice through lenders. And what we're proposing will therefore represent a significant change for some lenders in the market today, and we expect it's likely to accelerate the trend towards advised sales on the part of lenders generally. I mean, we've had, for some lenders, obviously this isn't a problem, and what we're proposing is aligned with where they're headed. But for others, and actually we probably saw the CML and the BSA reaction, with the BSA calling us broker-centric, which was something of an unusual allegation. So I think we were slightly taken aback by the lender trade body's reaction and some of the firms that we've spoken to, and we've actually read in the trade press that what we proposed has come as something of a bombshell to some. And when we consulted last November on the advice proposals, the majority of lenders agreed with us that there should be an assessment of whether a mortgage is appropriate for a customer in all sales. So basically, the view was that the same standards should apply, and that in every sale, the seller should be checking that the mortgage meets the customer's needs and circumstances. And this was confirmed by lenders in responding to the questionnaire requesting data for our cost-benefit analysis. We don't just make the cost-benefit analysis figures up. We send out detailed questionnaires to firms and ask them to tell us what the cost implications are for them. And when we asked whether they apply an appropriateness test similar to the current requirements in advised sales, the vast majority confirmed that that was something they already did. Most respondents also agreed with the introduction of a qualification requirement across all sales. A number of lenders felt that this would increase costs, which would ultimately be borne by the consumer, but others suggested that the incremental cost would be minimal, given that they already require or support completion of a relevant exam, such as the CMAT, Certificate of Mortgage Advice and Practice. But at the same time, that should say mortgage advisor at the top, but at the same time there was a concern that by requiring largely the same sales process, what we were proposing would actually enhance the consumer confusion about the distinction between a non-advised and an advised sale. And actually, we 100% agree with that. If it's the same sales process with the same professional standards, what would be the point in maintaining a distinction between advised and non-advised sales for the consumer? You know, if it walks like a duck, quacks like a duck, looks like a duck, why would you not call it a duck? In checking whether a mortgage meets a consumer's needs and circumstances, firms are advising on the merits of a consumer taking out a particular mortgage, and that is regulated advice. I think as some of the intermediary lenders mentioned earlier, there are areas where they're talking to us because they want further clarification. I think it is the case, and it's nothing to do with us, by the way, it's because of the way that the regulated activities order is drafted. Not every discussion that a seller has with a customer is regulated advice. What we talk about in the consultation and the rules are interactive sales. But of course, you can have an interactive dialogue that isn't part of the sales process, but simply part of what's been called the window shopping stage, where the customer is simply doing nothing more than collecting factual information. And I think we need to be a lot clearer about that when we go out with our policy statement, because there's a very clear distinction between information only and regulated advice. And as you've heard, there's been some debate around post-contract variations. Robert has talked in the press and in Amy's response about calls for lenders for a third way, as he's described it. So not just the two options of advice sales and execution only, but also a means of incorporating mortgage transactions or post-contract variations. And these are transactions where lenders process a range of administrative changes, such as converting a borrower from interest only to capital repayment, changing the parties to the mortgage, or extending or shortening the term, or agreeing a retention deal where there's no more monies being borrowed. At the moment, those post-contract variations are usually done on a non-advised basis. However, under our proposals, most of those transactions would require advice where there is an interaction with the borrower. This position is obviously welcomed by Robert and Amy, but not all feedback has been positive. And some have questioned the proportionality of that, particularly for relatively straightforward transactions such as retention deals, where an existing experienced borrower might easily be able to choose a new rate from objective information supplied to them without needing advice. So we are giving this further thought. And of course, we're interested to hear your views just as much as we're interested to hear the lender's views. There's no decisions on this being made. I think it's really important to stress that. This is still a consultation. We're still listening to your views, and those, we'll listen to that debate and then make our decision on the basis of all the things that we've heard. Amy has also asked about the implications of the proposals on forbearance. And that's where borrowers face the prospect of losing their homes, and lenders are required to find ways in which to try and avoid that, if at all possible. We see that as more of an affordability issue and meeting the customer's immediate needs to keep a roof over their heads and helping them over what should be, hopefully, a short-term problem. And our rules already require the lender to consider options appropriate to the borrower's individual circumstances. Finally, I want to mention Europe, another thing that Amy have raised in their response. The mortgage directive we don't know when it's likely to arrive. Discussions are probably going to have some considerable way to go yet. And we're still continuing to work with the government in promoting the UK's position. And that includes keeping buy-to-let lending out. The proposal generally adopts a higher level approach than the MMR, and in many areas, the directive is really very closely aligned with what we're doing on the MMR. The approach is mainly one of minimum standards, which is very good news, as that will allow us to continue with our proposals and which are aimed at reflecting the specific risks and features of our market. We want to have our regulatory approach, which is fitted for our particular domestic market, and not have something imposed on us from Europe, which is a one-size-fits-all approach across all nations. What we're picking up in responses to our consultation is that firms want regulatory certainty. It's clear that maintaining the published MMR timetable will at least give firms a clear understanding of what we're expecting. And there's also a risk that if we don't do anything and we sort of call a halt, then that will prompt others in Europe to act to fill the vacuum. And so our view is that we shouldn't be delaying the implementation of the MMR, but of course we will ensure that the timing of implementation of the MMR proposals is sensibly aligned with the European reforms to minimise the burdens on firms. Now, I said at the outset that I wanted to give you time to tell me your views today. I'm very happy to take questions or just to hear what your concerns are about the latest set of proposals, because obviously that will shape where we end up finally.
Nobody wants? Okay. Alex, go, Stacey. It's like good, but
Lynda, my name's Martin Simons. Interesting to hear you speak, and it's illuminating. The question I'd like to ask is, who made the decision that property won't rise over the next few years when it has done for the last 350 years in the UK? And second of all, the terminology I used earlier, which I apologise if it was a bit childish, was FSA banning interest only. I know it's not the FSA who ban it, but unfortunately the lenders do see the FSA as the guiding light and seem to have taken their lead from your narrative. If you decide that interest only is not quite as bad as it looks, because a number of educated people have made a decision that it's right for them, would you then translate that back to the lenders so that they might review their particular view on interest-only mortgages?
Yeah, well, it's quite interesting actually, because basically what we've said to the lenders, when we've had a really extensive consultation on this, so we've listened to the brokers and we've listened to the lenders and we've listened to the consumer representatives. Consumer representatives wanted us to be really prescriptive about what we would allow and what we wouldn't allow. Yeah, that was it. In fact, some people would really like us to ban interest only, and that includes lenders, by the way. Some lenders would have liked us to ban interest only. So we've listened to all the different proposals, all the different views, and what we accept is that interest only is right. It is the right product for some consumers. It shouldn't be a mainstream product because it's not the right product for all consumers, and we saw it being abused basically. It was used to stretch affordability when it shouldn't have been used to stretch affordability. But there are some consumers who are well able to meet the capital requirements at the end of the term. They can pay it off. And what we've said to the lenders is, okay, lenders, we're not going to ban this. What we're saying to you is we want you to take an informed judgment. So don't disregard the risk altogether, as we saw in the past. Oh, sorry, we saw that happening in the past. Don't disregard the risks altogether. We want you to think about it and make an informed judgment. So over to you, lenders. And the lenders who had said to us, we don't want prescription, we don't want prescription, all of a sudden, when it was over to them, wanted prescription. So, you know, we can't win whichever way we do it. We are saying, you lenders, you're lending the money. You need to be satisfied that the borrower is going to be able to repay you at the end of term. And over to you, you do that. We have not been prescriptive about what strategies they can and cannot accept. And I think John made a comment about we're going to be asking lenders to constantly review this and ensure that, you know, it's delivering, the repayment strategy is delivering. What we have actually said, and we got a lot of stick about this from the consumer bodies, by the way, but what we've said is that at least once during the term of the interest-only mortgage, you need to be going out and checking that it's on track. Now, we're leaving it to the lenders to decide when that should be, but what we've said is, but it has to be at a time when actually you can actually make amends if things aren't on track, so that you don't just hit the buffers at the end of the 25 years and it's a disaster scenario. So you, lender, have to apply your brain. You've got to think about when's the appropriate time for me to go and ask the consumer about this and go and do it. We've asked them to do that once during the term.
Thank you. Hi, Lynda. Hi. Is it not quite ironic, looking back over the past 10, 15 years, where previously lenders were allowed to do everything on a non-advised basis, we're not responsible, the customer made a choice based on the information that we gave them and sold them an endowment to support the interest-only mortgage potentially, where all of a sudden you're asking them to be responsible and they don't like it because they say, whoa, hang on a minute, we want you to tell us what to do. Where brokers have been doing this for years, where we look at a client's individual circumstances, and if something is not a good idea, we talk them out of it.
Yeah, absolutely.
But the lenders all of a sudden seem to be putting up a bit of a barrier to this kind of change when it does make a bit of common sense.
Well, you'd really have to address that comment to the lenders. I mean, what I would say is that when lenders have always been responsible for assessing affordability, by the way. There is a chapter in the current mortgage rules which is called responsible lending. And under that, lenders, before they lend, are supposed to check that the borrower can afford to pay the mortgage. And actually that also includes the capital element of the mortgage. So the rules are there. And I'm often asked, well, isn't the FSA at fault here? Because where on earth have you been asleep on the case? Because you haven't gone out there and made those lenders follow those rules. And actually, mortgage regulation came in 2004, okay? Not all that long ago, actually, 2004. And when we started to review the effectiveness of the mortgage regime 1 year later in 2005. And we did all sorts of thematic work, supervisory work, looking at responsible lending. And actually, that was telling us that things aren't okay here. But what we were hearing from lenders then was, let the rules bed in, work with us, we'll get there, you need to work with us so that we understand the new regime and we'll get there. And of course, we did that, and the regulatory philosophy at the time was to work with lenders and to help them get into the right place. And actually, I think those days are now over. We've got a new regulatory philosophy. The new FCA isn't going to do protracted thematic work to then decide that, oh dear, there's a bit of a problem here. I think the new interventionist report will spot a problem and actually go in there and do something about it. So we have put our hands up and we've said, yeah, we didn't regulate in the way that probably we should have been regulating, and we've learned lessons from that.
Well, touching on that, I'd say there are a lot of intermediaries in this room who have seen clients who we would have concerns over their affordability and the serviceability of a mortgage. We've then gone direct and the lender has granted the mortgage. And and I think that's where things do need to change, because, it's the brokers do, we are putting ourselves out there where if we get it right, we get it right. If we get it wrong, God help us. With the lenders on a non-advised basis, they say, oh, well, it was non-advised. We used our normal affordability.
I mean, I think in fairness, we did see brokers doing that as well, actually. Oh, yeah. We did see brokers using the non-advised route so that they got away with it.
And so, they shouldn't.
Yeah, but it was there. So you can't just point the finger at the lenders and say, that was you, Gov, because in fact it's a problem across the market.
But surely if the lenders are there policing the affordability, they should stop the case before it gets that far.
The whole point of our responsible lending affordability rules is to make the lender 100% responsible. No more confusion, because in the current rules, you've got lender responsibility in MCOB 11, and you've got broker responsibility in MCOB 4. So you've got this joint responsibility, and the market couldn't quite get its head around it. And we have said, forget all that. The lender lends the money. They're responsible for ensuring that what they're lending, they're going to get that back.
I think that's only a good thing.
I think one of the interesting parts of this for me is not to mix up what was and what is. Yeah. And I think that's the interesting part of some of this, is that clearly there were a large number of brokers in our industry in 2006 and 2007 who did some very bad things. The brokers who are left in this industry have had to fight very, very hard and run very strong, sustainable businesses for the last 3 or 4 years through very difficult market conditions. Therefore, the people who are left are very committed to being in this business for the long haul, not in the short term for quick gain. And I think that's something that I think the regulator needs to recognise, is that, and there will still be some rogues out there and we all recognise that, but we've got to deal with that as an industry and with a regulator.
Yeah.
But then it's about making sure that the rules that are applying on one side of the fence, i.e. the broker community wants to put their hands up and say, we actually want to take responsibility for advice here. We want to take that risk because we think this is the right thing for the consumer. What we feel uncomfortable with then, I think, is that a customer can be said, actually that's not very clever, can still walk in somewhere and get that same loan without advice, that therefore gets around the system. I think that's that level playing field that you're talking about that is the fair piece that works, if I'm rephrasing it slightly. Yeah.
Consumers need to be protected from themselves a lot of the time because their desire to own a property or to secure a particular loan can override their common sense.
Yeah.
They may ignore the voice of reason that's given to them. And if they say, well, you're not giving me what I want, I'll go to a loan that will give it to you.
Yeah, no, absolutely. I mean, I think that was one of the things that we have openly recognised, that there are cases, and of course, there is consumer responsibility. Consumers do have to accept some responsibility, but there is this irrational behaviour on the part of consumers who think, I want to have that lovely mansion that I saw yesterday, and it doesn't matter, I need to get the money to get that mansion. You know, unfortunately, that is a factor in this, and that's something that we need to guard against.
John, you want? This could be interesting.
No, I just, I agree with 99.9% of what you said. No, in terms of lenders lending to make sure that payments are made and they get their money back, that's obvious. All lenders are motivated and should have processes in place to make absolutely sure that people can afford the interest payments and that at the end of the day they get their loan back. You know, that's sensible policy, and it's nothing to do with consumers, it's to do with the lender's self-interest as a business. Where it goes beyond that, and which is where you're obviously coming in, is you go beyond that. It's not only do lenders have to ensure that interest owed is paid and they get their money back, but you've got to be concerned about the consumer's welfare and whether they can get it paid back in the right way. You know, interest only at 25% LTV, lenders will get their money back, they'll just force them out the house.
Yeah.
That doesn't bother me because
No,
as
I
long
know.
as it's sold with clear information,
Yeah.
if I'm stupid enough as a consumer to enter into interest only without thinking about how to get it back, as long as the lender is safe in terms of 25% LTV, it's my risk as a consumer, and I don't think a regulator should put it upon the lender to say you can't lend to that person because you haven't sorted out whether you can pay it back through another way.
But John, I mean, that's not what we're about as a consumer protection regulator. And what we've had really interesting conversations with our prudential colleagues on this, because quite frankly, if they price for risk, and all the points that you were making earlier, you can price for risk and prudentially it doesn't matter because you're a covered lender, you're okay. The problem is that you've got a consumer on the receiving end of this that we need to be concerned about because our objective, our statutory objective, is consumer protection, unlike the prudential guys who are only interested in financial stability. So there's this interesting tension between my prudential policy colleagues and me. And we actually look at this in the prudential chapter that's in the consultation paper. Because, yeah, of course we could say, yeah, it's great, because prudentially these guys are all okay. They're adequately pricing for risk, and of course they weren't at one stage, but that's going to be fixed. So they're adequately pricing for risk. Forget about the consumer. We cannot forget about the consumer.
But it does assume, therefore, the consumer can't look after themselves. They're too stupid to make decisions like this by themselves, so you have to make those decisions for them.
I mean, that's a big debate, isn't it? And that's actually quite an interesting debate for the Financial Conduct Authority, because it's the extent to which, what degree, and of course the chairman's very hot on this, where does that line stop? To what extent do we need to be interventionists to protect the consumer? You know, that's the big debate on product regulation. Is it right that we do that? And I think that's quite an interesting debate that still is being played out.
I mean, you've not said that sale of property is banned. You've just said that sale of property has to be very carefully considered in that respect.
Yeah, I mean, it's we've said that obviously downsizing is a viable proposition for lots of customers. One of the big problems we found, and I'm sure that the lenders who are around here will be able to tell you this, it's a really, when a consumer enters into a mortgage and it's 25 years down there somewhere that they're going to have to downsize, By the time they get to that period, and they've got their lovely home where they brought up their kids, and you know, that's it, that's my garden, that's my everything in here, all the memories I have, they do not want to downsize. They don't want to sell that property. And firms don't want to take the reputational hit, because it would be major, of turfing somebody out at that stage. And I think that's something that, you know, we really do need to think about. Consumers need to understand that if they enter into a mortgage with their eyes open, meaning that, you know, agreeing to sell the property at the end of the term, that's exactly what happens. Well, at the moment, we've got lenders sort of wishy-washing around that area, and I think that we need to be a lot clearer about what the implications are of the lending, the borrowing decision as much as the lending decision that's being made.
James, just give me a second, get the microphone so everyone can hear. Great, thank you.
I can't resist just coming back to you on that. I mean, that is the very kernel of the issue, or at least one of the big ones that I personally see, without talking about nationwide. But, you know, is 10 years, 20 years down the line, what view will the, you know, we live in such an increasingly litigious world that 10, 20 years down the line, where would the ombudsman sit on this? Where will claims companies sit on this? You know, I mean, it's all very well, you know, now saying it looked good at the time, and then we come into this scenario. So.
But what we're basically
and we've
asking,
got our name stamped on it, by the way.
No, absolutely.
I mean, because of the review that you indicated. Yeah. I mean, you said once maybe we have to review it. Maybe prudently we might want to review it more than once. But by definition, as a consumer, as a customer, then thinks that, you know, we're reviewing their repayment strategy, then they think we're responsible for their repayment strategy.
Well, but I think that's, again, being absolutely clear with the customer what your responsibilities are. What we've said is that at the day that you're underwriting a particular mortgage, you will make an informed judgment at that time on the facts available to you on that date about whether this could pay off. Now, of course, you cannot be held responsible for the fact that some investment portfolio doesn't actually meet its targets. You can't be held responsible for that. You can't be held responsible if the person who says, I'm taking out an ISA, then decides that they're going to cash it in a week's time once they've got the mortgage. You cannot be held responsible for that. And when we've had discussions at the CML working groups on this,
yes, I'm aware
what we've said is what's absolutely vital is record keeping. And what we've said is that when the supervisors go in, they will want to reconstitute the lending decision that you made, and it should be, you know, it should be there. They should be able to do that, and if they're able to do that, then there shouldn't be an issue.
Okay.
Okay, I'm mindful of time. I'd just like to say thank you to you for attending. Thank you to Lynda for coming to talk to us today. I'm going to ask you to show your appreciation the usual way, ladies and gentlemen. Thank you.